What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to discuss why I believe that passive diversification is slowly and steadily dying, and I think it's a lot more important for investors to actively participate if they are looking to diversify their portfolios moving forward. And this is backed by some data which I read earlier today, which I think is very, very interesting with respect to the percentage of weighting that's been given to US equities, and more importantly, the top 5 stocks in the US alone, accounting for a significant portion of the global market indices. So hope you all enjoyed this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Again, there is a few more spots left, 3 more spots left for our Patreon and our Discord with the link down below. You're more than happy to join. There is a 16% annual discount that's available until the end of this month. You get access to our, now going to be starting very soon, our weekly newsletters, the moneyvest.com website, and of course, a lot of other benefits, including private members-only videos, the trade alerts, the trade ideas, options alerts. Everything's going to be included with the link down below. Also, don't forget to connect with me on Instagram if you'd like. I do post a lot of interesting stories there. Also, my handle is going to be CASWRP. And again, the link to our Patreon and Discord is going to be down below. Would love to have you on board there. Now, this right here is S&P 500, where it can keep up, right? So S&P 500 already blows past the 2024 year-end targets by strategists. And as we already know, we're hitting a new all-time high. This has been a very fantastic start to the year for the markets, as January, February, both months have been somewhat positive, and the markets have continued to rip higher on the back of technology and, of course, big tech, Magnificent Seven companies, as recession expectations have come down in February of 24. So Bank of America expectations, a global recession is less likely, of course, compared to November of 2022 or April of 2020. So we have significantly come down on those expectations by the fund manager survey as well. Now, this right here is what is quite interesting. So mega cap tech stocks aren't just powering the US stock market anymore. They're also holding the world together, and US equities now comprise of 70% of the MSCI World Index, the benchmark for large and mid-cap companies across 23 developed markets. So that's 23 countries that this index kind of is made up of, and 70% of that is US equities alone. And this level represents the largest country weight since the index's inception in 1986, and correspondingly the lowest exposure to non-US stocks. And the top 5 large cap US stocks, which is Apple, Microsoft, Nvidia, Amazon, and Meta, account for nearly a fifth of the index. I'm surprised they didn't account for Google, which is top 6 of the US companies. So including Google, I'm assuming it accounts for more than 25%. I'm assuming 24% of the overall global index. This is not just the S&P 500 or US markets. This is the global index we're talking about. And this is exactly why I believe that passive diversification is dead or is dying slowly. And what do I mean by that? Is because a lot of people, especially when you consider portfolio managers and just investment planners in general, they tell you that if you want to diversify, buy into a broad-based ETF or an index fund. Broad-based meaning that has multiple different stocks. But now it's gotten to a point that at the end of the day, you're really only buying 5 or 6 companies, right? They're really the ones that are charging and driving your portfolio because of how much that significant weighting has become. And this basically goes over that idea that if you essentially invest $1, so if you allocate $1 of your retirement account to the passively to URTH, that is Earth, and iShares ETF to MSCI World Index, that's the ticker symbol, 70 cents goes into US equities and 18 cents goes into the top 5 US stocks, and top 6, I'm assuming it's going to be a little bit over 20 cents, is what Goldman Sachs Managing Director also mentioned. And the MSCI World Index shifts regionally and country weights based on broader economic trends. Japanese equities accounted for more than 40% of representation during the 1980s, prior to the asset price bubble. And in the early 2000s, European markets grew to more than a third of the index weight due to the strong economic growth. However, no single market has achieved such a high level of concentration as the US markets in this index, which is 70%. It's actually quite crazy how high concentration risk there is with respect to not only the world index with regards to the US equities, but also within the US indexes with regards to the top 5 and top 6 stocks. Now, BCA Research Chief Investment Strategist Peter Berzin said that this concentration is reminiscent of instances that preceded steep market downturns, high levels of market concentration in the late 1920s and early 1930s, as well as 2000s coincided with market tops. Ironically, the stock market tends to rise during periods of increasing concentration because winners keep on winning, and losing stocks don't tend to perform any better. And Berzin said, while noting that it's unclear whether concentration will further rise. And the market is kind of in a dangerous ground right now, and the risk of something going wrong is quite elevated. And so I think longer term investors should take what they're seeing now with this mega cap tech rally as an indication that the party will probably be over by the end of this year. So those are obviously some things to consider because as we continue to see this high levels of concentration, the premiums they command is dangerous for us, is what he says further. And as long as momentum is in the Magnificent Seven, short-term portfolio performance is going to be hinged on the good and the bad of it. And there is risk in the late stages of these kind of run-ups when everything is really frothy and euphoria is large, that if you don't participate, you do get canned at the same time. So, when it comes to just being an active manager, there's no way you're holding massive overweights to all of these names. And so it is definitely challenging from an active management perspective, but it doesn't necessarily mean that it can keep happening, is what they also mentioned. So, when you look at your own portfolio, you look at, diversification, I think it's really important for investors, for retail investors also, to actively look at other opportunities. Because if your goal, if your idea is to simply just buy and hold the broad-based ETFs or indexes, then you also have to understand that at the end of the day, like, you may think that you are diversifying, but at the end of the day, like, you're really not, because you're just holding on a significant concentration into these Magnificent Seven companies and these tech stocks. Obviously, the performance will be a lot better in a bull market if you are in these 6-7 names versus the index, but in a bear market, the performance will be a lot worse also. So the volatility and the risk profile is going to be more for someone that is holding these 7 stocks versus the index versus somebody who's holding the index versus the 7 stocks, because index allows you to be a little bit more less volatile. It allows you to be more safe, more conservative, because it's got the backing of other names in the portfolio as well. But I think it's really important for investors to start looking actively outside of these indexes, whether it's fixed income, whether it's real estate, whether it's REITs, whether it's other parts, other asset classes, to take advantage of diversification, right? Because diversification is also really important. That's what Ray Dalio preaches, especially in a world where we are increasingly seeing inflation continue to be a little bit more elevated. We're seeing interest rates continue to be a little bit more higher for longer. This is not the same time as what we experienced back in the 1980s, 1990s, even prior to that, where there was just a few places to invest in. Now with the rise of cryptos, now with the rise of real estate and artificial intelligence, there's a lot of places to look for and to diversify outside of just Magnificent Seven and tech companies. I mean, that's still going to be my core. That's still going to be a place where I primarily invest in, but I am going to be investing in other areas as well. Alternative investments, also a place, and even commodities, for example, gold and silver. Not that it's going to be a big part of the portfolio, but definitely something that to look into from a diversification standpoint. So you're not kind of just looking at these 7 names that are holding up the entire market, not only in the US, but also in the entire world. And the US equities make up over 70%. So it's really important to kind of understand, like, if you are putting $1 in these indexes, most of it is going towards these Magnificent Seven companies. So that's where we are. Hope you guys enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. Let me know your thoughts down in the comment section below for our analysis here. And again, do drop a like and subscribe. Happy investing. I'll see you all in the next video.